If you don't understand how to calculate pips, how lot size work, you become a gambler. And for that reason, follow this strategy. It does not matter you watching this video 3, 4, 5 times for you to understand it. It is not complicated. If you can learn this and understand it, you save yourself from blowing accounts every day. Today, we'll dive deeper and we are going to learn how trade are measured, how you make profits or loss, and how all of these are being calculated in the Forex market. All you have to do is sit tight. I'm going to promise you that there's not going to be big English terms, it's going to be straight, accurate, and simple. Today, you will understand how to start your trade. And today, you will understand them. All of those things that have been mentioned, those grammars, everything, we're going to simplify them. So let's start. What is currency pay? This is the first question that a newbie trader will definitely ask. You used to hear currency pay. What is currency pay? Well, as we mentioned in the previous training, Forex is all traded one currency for another. You buy this one and sell this one. And that's why currency are always written in base. Like this is Euro USD, or you have Great Britain pounds by Japanese yen. Now these are pairs when we talk about pairs. Now what does it mean? This is Great Britain pounds, Japanese yen. Now that's how it's been written. Now, so if you're trading, this is how you're going to see it on the charts when you get to the chart level. So let's break it down in pieces so that you can understand better. The first currency in the currency pay is always the best currency, and the other one is always the quote currency. So it's just like we are saying $1 is 1,500 or 2,000. That's the meaning. So if $1 here is 1,500, so this is always the best currency, which is mostly stronger, and this one is weaker. That's the language. So if we are now talk about this, and we are saying that okay, 1 euro USD is 1:1,000. What we are saying is that 1 euro is definitely $10. That's the language. So if at this point the price happen to change, now instead of this, maybe probably may now become 1:1,050. You know what this means? This simply means that the euro is becoming stronger. Before it was 1,000. Each euro was 1,000 before, but now it's becoming stronger by 50. Do you get it? I believe the message is clear. Now I want to take this step by step so that you will not miss anything. Now that small changes that happen, whether it was a profit or a loss, means a whole lot. It means a whole lot in the market. So this is where traders take advantage of us. So you're not scamming people, but rather you're learning how to use that. When dollar goes up, when euro goes up, when pounds goes up, when it comes down, you use it and make profit. So then this happened to be the best currency and the quote currency. The ISTO is the quote currency. So the next thing we'll talk about is PIP. What is PIP? In the life of a forex trader, this is very important because this is what gives you money. Now PIP is being spelled PIP. PIP. Now PIP, a simpler term you can refer to as Kobo. You know, I promise to teach you this in a simpler way that you can understand. So PIP is like Kobo. Put it in your head as Kobo. If you're a Nigerian, the smallest amount, or if you're a US cent, the smallest amount you can ever think of in currency pairs in the market, you use PIP. So PIP stands for the percentage in points. Percentage in points. Don't crack your head too much. I'm going to break it down for you to understand. PIP is the smallest movement that happens during the currency pair. Now, that currency pairs that occur, that PIP movement, that small movement that just move like this, tick, tick, it's just like second. Or you go use another. If you're not using Kobo, you're using second. Each second that moves in the market, it stands for a pips. Each second. So I want you to break it down in that simpler thing. So each time a second moves, if it moves in your favor, you make profit. If you move against you, you run loss. Now let's put it this way so you can understand. Now let's start this example. Imagine that the Euro USD move from 1:1,000 to 1:1,001. You notice that it was just 1, and that makes it 1 pips. Do you get it? Do you get the point from Nango? So I just hope you understand the way I'm going. So it's like before now it was 100 naira 0.00. There was no money, but suddenly let's see something good happen. Naira move up or dollars move, whatever happens, 100 point 100.01 kubo. 1 kubo is added. Now this one is 1 pips. I want you to understand it that way. So in Euro USD, that one that added here is known as 1 pip. Now this 1 pip is the way money move. As the market move, if this market move in this 1 pip in your favor, you make money. If it goes against you, you lose money. So this is how the market is being measured. It's measured per pips per second. It's just like saying 1 second I've moved up or 1 second I've moved down. I want to teach you this thing in a simpler term that you can understand. I don't want you to lose or to be confused. Each second that moves up or move down in the market is 1 pip that move up. So if you move 2 seconds, so they'll now calculate how many seconds did the market move in my favor. Was it 10 times? Was it 20 seconds? Was it 50 seconds? As it moving like that, don't worry, when you go to the chart, you're going to see that happening. So when you see it moving like that, that's profit for you or loss for you, depending on the area that is going. Hope it's clear. Now that is how pips is being measured. So pip is the smallest amount of movement in the market. So each time it moves, and the market is measured by that. In the advanced class, I'm going to teach you everything step by step. So just follow me through and don't get distracted. Let's go to what we call lot size. Lot size has been spelled as lot size. Yes, that's the next thing we'll talk about. What is lot size? So let me talk about how much you trade, how much you're going to trade. Now that's just the meaning of lot size. You see, traders have something like they call, okay, I buy 1 bag of rice. Do you understand now? 1 bag of rice, 1 basket of tomatoes, and 1 acres. In the Forex market, the same way we have 1 tomatoes, 1 basket of tomato, and 1 bag of tomato. So I want you to understand it this way. Let's make it very simple. Let's just use 1 cup of rice. 1 cup of rice. Then we also have 1 bag. 1 bag of rice. Then we also have 1 truck of rice. Good. Now all of these are 1, but they are not the same. So I want you to have this understanding. They are not the same. This is 1 cup of rice, 1 bag of rice, 1 truck of rice. Which one is bigger? Definitely this is bigger. So then if you go to market and you have money to buy 1 truck of rice, if you buy 1 truck of rice and come, you make sales, you're going to make profit than this person. These are called lots. These are called lots. So imagine that you buy 1 truck of rice and you come and sell, you make profit than the person that bought 1 bag and sell at the same time, or the person that bought 1 cup or 1 jerry can come and sell at the same time. You will make more profit. But on the other hand, what if you run loss? You run loss here. You lost more money than this person. It's just the same understanding. So this is the amount that you said, okay, I want to use and trade. I don't know if it's clear now. In Forex, we do not use 1 cup. We don't use 1 jerrycan. We don't use 1 basket. In Forex, what we use is called lots. The lot size. The size that you want to trade per pips. Now this size value per pips. There are 3 major sizes that you should know. The first one is the standard lot size, which is 1.00. Is a standard lot size. Then mini lot size is 0.10, and the micro lot size is actually 0.01. Is the micro lot size. Now these are the sizes in the market. Now the value per pips. Now when I say value per pips, remember I talked about pips earlier. Now pips is the movement in the market each second that moves. So depending on the lot size that you choose, whether you choose the standard lot size, the mini lot size, or the micro lot size, depending on which one you choose, this determines how much you make or how much you lose. Now if you choose the standard lot size, each pip that moves in the market, or each seconds that moves, not just second in time, not seconds as the time, but each seconds of pip, each pip that moves in the market, you under the standard lot size, you are making $10 per pips. $10 per pips. What about the mini lot size? The mini lot size, you're making $1 per pips. What about the micro lot size? You're making $0.10 per pips. That's what you are getting as each pips is moving. So I want you to imagine that this pips was able to move like times 10. So that's like $100. I don't know if you're getting the message from that angle. Yes, that's just the truth. Now if you place this trade and make 10 pips, that means you make $100, Here you make likely $10 here. You make $10 here, and here you possibly make $1. As you're actually making this profit, you can also be running loss. In the same way, as you're making $100, you can be running loss of 3 pips, 10 pips. You can be running loss and be making profit. So I want you to have this understanding. Before you can start trading with your real money, you need to understand proper risk management and how to set loss size. The kind of loss size, you need to understand this very well before you see if you're going to use the mini loss size or the micro loss size or the standard loss size. You need to understand proper risk management so that you will not be blowing your account. Many of you that have been blowing your account is as a result of not knowing the kind of loss size to use. Because you hear that someone is making $1 million, someone make 1 million. Yes, it's true. 10 million. It's possible. Yes, but that is when it goes on your favor. So you don't just need to just click the buy or the sell button. You need to understand this proper risk management. Better still, I'm still going to teach you all of this in this class. Let's move to the next thing, which is spread. What is spread? You know, this happens to be the hidden cause of trading and is known as spread. Most traders don't even know that these things exist. But I know that you always see this negative line that always show anytime you want to place a trade. If I've ever placed trade before, it always starts with negative. Maybe something like a minus 0.40, sometimes minus 0.7, depending on the cost of the trade. It could be some minus 0.100, or just there must be a negative. All trades start from negative. That is spread. This is what brokers use to survive. It is this spread that they charge you first, and they use it to survive. So I'm going to explain it in detail for you to understand. First, what is a broker that you should understand and the spread. Now, I know I'm going to talk deep about this on when I get to broker, but let me just shed light. Now, brokers are like banks. You cannot walk into the central bank and say, I want to deposit money, I want to save money in central bank. You need commercial bank, like all these small bank, Access Bank, Eco Bank, you need them. So they're the one that you go and deposit your money. They will now take your money and go to central bank and save it there. So when you need your money, you go to the commercial bank and collect your money. That's how brokers are. You yourself, you cannot go to the central bank and say, I want to trade Euro USD. You cannot go to central bank and say that. No, you can't say that. So instead of you say, I want to trade, you need to go and meet a broker. Now, the broker has ability to accommodate a lot of persons. I want you to know this, that we the retail traders control just 5 to 10% of what really happens in the market. We are not the one that control the major thing that happens in the market. So for that reason, you cannot walk into central bank and tell central bank, I want to trade Forex with my money. You don't really have that much. You need a big amount of money. So the brokers stand in between you, the government, the banks. They bring you in, give you a platform to trade. So for that reason, they charge you spread. I will talk about brokers in detail when I get to brokers level, but right now I'm talking about spread. They charge you spread. Now that spread is what allowed you to enter the market and make profits. So let's put it this way. Let's make it this way. Let's assume that you buy Euro USD at 500 Naira. Let me use Naira in this explanation. At 500 Naira. Yeah, let's assume that the actual price is 500 Naira, but you will charge 600 Naira. So what is the spread? 100 Naira. Do you understand now? That's how simple it is. The actual price is 500, but the broker sell it for you at 600. Now every bank does this. Every bank does this. I want you to see this. Go to your bank. There's always a notice where they put the chart. The current price of dollars is always there. It's changing every day. It's there. So when you go check, you're going to see that the buy amount and the sell amount is always different. I want to tell you that everybody are doing Forex, but you don't know. Now when you just go and check, you see that. So the difference in that amount is the spread. That 100 Naira difference is the spread, is the profit margin. That is the spread. So the brokers use this amount of money to run their business, to give you access to the market. Let's put it this way. Let's say that you buy Euro USD at the price of 1:1002. Let's just assume that. And you sell it at, I want you to understand something here. This happened to be the bid price, okay? And it was at 1.1000. You buy it at the ask price of 1:1002, but you now sell it at this bid price of 1:1000. What is this telling you? That there is a minus of 2. That is what we call spread. That 2 pip is the spread. That is what the broker have charged you in order for them to give you access to the trade. They give you access in. The broker, this is what they use to make their money. This is how they make their money. So when you enter a trade, you will notice that there's always a small negative, like a loss. Like all the time you start your trade is always at a loss, no matter what. It's not as if the trade might not be at a loss, but the truth of the matter is that the broker will charge you first before you make profit. So you need to make money and pass the negative first before you now go forward. So the broker will charge you first and use that to sustain themselves and move forward. Hope you've understood that. So let's summarize what we have learned in this particular training today. The first thing is that we'll talk about the concept. Pips. Pips happen to be the smallest price movements in a currency pair. The smallest price movement in the currency pair. Write that down. Now I cited it example as per second. Yes, though I'm not referring to time, I'm referring to the movement in the currency pair, whether it's going up or it's coming down. So that's what I'm talking about. That's pip. Pip is that movement. The market move up. 1 pip, 2 pip, 3 pips. That's pips. Or it moves down. And the second thing we talk about in this particular training is lot size. Lot size happens to be the volume that you want to trade. What's the volume you want to put in the market? And that determines how much you make or how much you lose. How big your trade is going to be, your trade size. Another thing we talk about today is spread. Spread is how brokers make their money. That's what they used to charge you to give you access to the market. It's just like you go and save money in the bank. Bank are actually charging you. When you deposit, they charge you, or you withdraw. Every withdrawal you make, they charge you. When they give you their ATM for you to use and withdraw money, that card, that is, you swipe the card, they charge you. Do you understand now? You make transfer, they charge you. So they charge you for that services. So brokers also charge you. Brokers are like the bank. Now I also talk about currency pairs. Currency are what is traded. Example is Euro USD. Let's take a real life example. Let's say that you enter a trade of Great Britain pounds. Pay USD, United States dollars, and you actually enter this trade at 1:2500, and you entered it at that, and it moved up. This moved up to 1:2510. So the question is, how many pips? That has given us 10 pips. I don't think this is confusing. I think this is clear. That's just it. That's 10 pips. So let's assume that, okay, this trade that you actually placed here, you were using the standard lot size, which every pips is $10. Every pips is $10 at the standard lot size. Every pip is $10. So that will be 10 times 10. So you have $100. So what if you use the mini lot size, which everything that happens there give you 0.1, so you're making $1. So it's going to be this times this, so you're going to make $10. I'm explaining this part again before I skip, because I don't want you to jump in and jump out. You need to understand this part. I know I've talked about this already, but there's a reason I'm taking time to explain this once again, because this is why people blow their hands. So they lost money, this and that in the forex market. This is where the problem is. Some will just take small accounts and go and take standard lot size because they want to make $100 at a pip or at 10 pips, just want to make big money. That's why I'm taking time to explain this. It is better you manage your account until you have big money, then you can now take big risks. So now, if you're using mini lot size, when this person is making $100, you will not blame yourself. You manage your $10. Or if you're using micro lot size, when this person is making $100, you manage your $1. Like that, they can still build your small account until it becomes big. Now, one thing I'll tell you about Forex is that your capital is the secret. Once your money finish, you're broke. It's just nothing but the truth. So you need to manage it. So if you're actually using the micro lot size, and every time this person is making $100, you're making $1, you manage it. You need to understand this, and I hope you're getting it. Understanding pips and lot size is very important in the life of the Forex trader. That is very important. And in this, I've explained to you how it's been calculated for your profits or for your loss. You need to take time and understand it. Go through this training, watch it over and over. That's why I spent time to make it a recorded one, so you can watch it again. It should not just be like, okay, you just listen to me and it's passed. Watch it again for you to understand better. Please take it. If you're going to watch this training every day on a daily basis, please do it for you to understand. As we believe in, I'll be leaving you with the assignment, because this is how we train people. Download or go open your MT5. And when you open your MT5, find currency pairs like USD or Great Britain pounds USD. Find the currency pairs. Now, when you found this currency pairs, try to observe the bid and the ask price. Observe the spread. What was the difference in it? Observe it carefully. Then check how many decimal places the price move. Now, these were the pips. Try to see as you can calculate it. Get it done. And when you're done with that, then message me, drop comments in the comment section that you are done to show you've complete is very bad. This is my final word for this particular training. In Forex, you don't get paid by luck. You need to understand this part. You don't get paid by luck. You get paid by precision, by being definite about what you're saying or what you're doing. Understanding how price move using pips, lot size, spread is what separates you from gamblers. I mean, it's what separates professionals from gamblers. And I know you're not a gambler. You want to become a professional. So that's why I'm spending time to train you like this, because I want you to become a professional. I'm not rushing because I want you to get the in-depth. If you don't understand how to calculate pips, how lot size work, and all of this work, you become a gambler. So I want us to keep winning. And for that reason, follow this strategy. It does not matter you watching this video 3, 4, 5 times for you to understand it. It is not complicated. You see what I explained just take a short time. I'm done explaining it. But understanding it will take you time, because you need to go through it over and over and over again. It took me years. It took me time before I understood it. So the same thing it will take you. But if you can learn this and understand it, you will see yourself from blowing accounts every day. See you in the next training.